Hello everyone. This is Sahil and welcome back for yet another episode. It's been a while. Before we start, I have this very interesting chart for you guys to see. This chart shows the relative standing of world powers in the last 500 years. The three takeaways that I have from this chart is that no matter how strong an empire or a country is, eventually it sees a decline and somebody else takes its place. Secondly, the rise of power has been significantly faster as time went by. So it took 3 generations for the British Empire to see its peak, 2 generations for the US, and in merely 1 generation, China has become the power it is right now. The way this is moving ahead, China is bound to surpass US as the world's dominant power. Now, I also made an episode on why US might see a decline in the next decade or so. If you're interested to check that out, I will leave the link in the description below. In this episode though, let's look at the factors why China saw such a boom in their economy, where they stand right now, and where they headed to so we can make an informed investment decision. So let's hit it up. China's economy has enjoyed 30 years of explosive growth, making it the world's largest economy. According to the World Bank, it has experienced fastest sustained growth by a major economy in history. It's not a hidden fact that China took advice from Singapore to structure its economy, and the similarities are easy to see. But what's astonishing is that it was able to scale what Singapore has done for such a huge country, and that's simply amazing. Anyways, let's look at the various reasons why China is where it is right now. From a country that was so fucked up that they literally had to eat whatever they saw moving, to a world power that it is right now. There were 5 factors in my opinion: governmental spending, cheap exports, technology transfer, getting rid of religion, and tackling corruption. China fueled its former growth by massive governmental spending. The government owns strategically important companies that are dominant in their industry. They control the big 3 energy companies, the PetroChina, Sinopec, and China National Offshore Oil Corporation. Government ownership has allowed China to direct these companies to high priority projects in order to meet their long-term goals instead of focusing on short-term profitability. These massive spending by the state-owned companies are only possible by taking up loans, and the government has historically kept the interest rates low so that the state-owned enterprises can take huge debt with minimal effects on their ability to repay. Now let's talk about the second factor, the cheap exports. China has emerged as the world's largest manufacturer according to the World Bank. Gross value added data in this chart over here reflects the actual value of all the manufacturing that occurred in the country. That means that they subtract the value of input and raw materials that were used in the production. In 2016, the value of China's manufacturing was 49.2% higher than that of US, and this is really what brought China where it stands today. After all the reforms, China has developed into a massive export economy. Almost everything that we are surrounded by today is most probably made in China. The main reason behind this is that with all else equal, their products are insanely cheap. How are they able to keep their exports cheap? Well, the People's Bank of China, the nation's central bank, tightly controls the yuan to dollar value. It does this to manage the prices of exports to United States. It just wants the prices to be slightly lower than the goods that are produced in US. It can achieve this because China's cost of living is lower than that of the developed countries, and by managing its exchange rate, China can take advantage of the disparity. So it's easy to buy Chinese goods in dollars, and this also makes imports expensive. Now, if foreign companies want to sell to the Chinese population, they have no choice but to manufacture their products cheaper, which for a long time can only be done effectively in China. So they have to set up factories in the country, which further boosts its growth. And that brings us to the third point, technology transfer. China requires several things from foreign companies if they want to do business in China or they want to work with a Chinese company. One is that they often must share their technology. And Chinese companies in the past have used this technology to develop their own products. Although Chinese companies are not the only foreign firms seeking to acquire US technology, the Chinese case is unique because the Communist Party has made technology transfer a matter of policy, and they provide direct and indirect support to any company that is engaging in these practices. The fourth factor, getting rid of religion. This and the next point is what I believe has pushed China so far ahead of India that you can't even compare them anymore. China got rid of religion, and that doesn't mean that they took away your freedom to practice any religion that you want to, but what they did is to limit the religious practices to temples and homes. It's stated in the Article 36 of the Constitution of China that citizens of China enjoy freedom of religious belief. No state organ, public organization, or individuals may compel citizens to believe in or not to believe in any religion, nor may they discriminate against any citizens on these bases. The state protects normal religious activities. No one may make use of religion to engage in activities that disrupt public order, impair the health of citizens, or interfere with the education system of the state. If you see what's happening in India, you'll understand that how religion can be used in politics to bring people into power, keep them there, and allow them to slowly destroy the country for their own benefits. The only objective of any religion is to spread peace and hope. If it's being used for any other purpose, it's toxic. And China has successfully removed this toxicity while still letting its citizens have freedom to follow any belief. To the last factor now, tackling corruption. Corruption can never go away from a society. It's always part of it in one way or another. Hence, it can only be minimized. Xi Jinping launched a huge campaign in China to tackle the growing problem of corruption. And the best thing they did is to make it punishable by death. Some say that it was just a power play where he was trying to eradicate any officials that were a threat to him by charging them with corruption. But there were even cases where corruption by officials were brought out by members of the public and severe actions were taken against them. All in all, I feel that extreme punishments like this just serve a purpose of deterrence. Like in Singapore, you can be fined $500 for just drinking in the public bus. Nobody wants to risk that much, even though the country doesn't have much resources deployed to catch you doing that, and the chances of you getting caught are very low. But it still works. It simply is not worth it. And similarly, it's not worth losing your life getting caught taking a bribe. It just doesn't stop people from taking bribe, but also discourages people who want to be in politics only to make themselves rich through corruption. Again, look at India over here. The sole reason people want to get into politics is to take bribe and get rich, period. Hence, you can see that all of them are a bunch of uneducated goons. There of course are exceptions, but these gangsters don't let them and their families live an easy life, further discouraging sincere people from getting into Indian politics. All in all, China has significantly minimized corruption in low ranks at least, and I believe I don't have to explain how this translates into economic growth. Now, with the first segment covered, let's look at where China currently stands. I know when I mentioned in the start that China was the world's biggest economy, some of you would have gone like, no, it's the US. Well, it is, but in USD. But the thing is, you and me in our own countries don't use the USD. We use our own currency, and the purchasing power of US dollar vary from country to country. This is called the purchasing power parity. To adjust for this, the World Bank uses a so-called international dollar to compare the GDP of different countries. According to that, in 2019, it represented 17.3% of the world's $130 trillion GDP, whereas US was at 15.8%. Though China's GDP per capita is still very low compared to US, and they still have a long way to go. However, growth is already making China a world economic leader. Its growing economic power has led it to become increasingly involved in global economic policies and projects, especially infrastructure development. Its One Road and Belt initiative represents the grand strategy by China to finance infrastructure in Asia, Europe, Africa, and beyond. If successful, its economic initiative could significantly expand export and investment markets for China, hence increasing its soft power globally. Soft power is like doing a favor to someone and in return they will be in debt to you. Anyways, China is currently going a major restructuring of its economic model. Policies that were employed in the past to essentially produce rapid economic growth at any cost were very successful. However, such policies have entailed a number of costs such as heavy pollution, widening income inequality, overcapacity in many industries, an inefficient financial system, rising corporate debt, a housing bubble, and numerous imbalances in the economy. Therefore, the old growth model are viewed by many economists as no longer sustainable. China today somewhat reflects the US of mid-1980s, and as its development began to converge with the major developed countries, it has no choice but to transform into an innovation-driven economy. If it is unable to pull off this transformation, it could face a period of stagnant economic growth and living standards, a condition referred to as a middle income trap. So with that, let's move on to the last segment of the episode and see where China is headed in the future. China has sought to develop a new growth model that promotes more sustainable economic growth and puts greater emphasis on private consumption and innovation as the new driver for the future of Chinese economic growth. Implementing a new growth model that sustains healthy economic growth could prove challenging, and Chinese leaders very well recognize this. In order to avoid the middle income trap, they are coming up with new reforms, and as a result, they are willing to pull back the throttle a bit and accept a lower rate of growth of about 6% for the coming few years. These reforms will shift the economy from one based on government spending, state-run companies, and low-cost exports towards private investment, innovation, and domestic consumption. To achieve this, they have come up with initiatives such as Made in China 2025, which comprehensively upgrades the manufacturing industry, and it focuses on innovation and quality over quantity. The plan prioritizes 10 different industries: new advanced information technology, automated machine tools and robotics, aerospace and aeronautical equipment, maritime equipment and high-tech shipping, modern rail transportation equipment, new energy vehicles and equipment, power equipment, agricultural equipment, new materials, biopharma, and advanced medical products. They are also reforming the banking sector in order to create competitive financial systems. In the past, the government lowered the interest rate in order to increase borrowing. As a result, corporate debt was 150% of the GDP in October 2020, which is double the US levels. Now it is slowly allowing the bank to raise its interest rates for the consumer deposits. The government is also encouraging new privately held smaller banks. They are financing the innovative companies, and that drives competition. Innovation could help companies to grow enough to launch an IPO. In the past, the government decided which company could list on the stock market. The reforms can allow the companies to make their own decision and also rely less on debt to raise capital. These changes are needed but risky. Other countries such as Norway, Argentina, and Thailand liberalized their financial sector, but within a few years faced a banking crisis. China also wants its currency, the yuan, to replace the US dollar as world's reserve currency. This could give it more control over its economy. To summarize, if you understand the blueprint of the economic reforms, all the warnings about China's slowdown and collapse will be less alarming. This includes the drop in yuan to dollar value and also the 2015 drop in the Chinese stock market. The recent slowdown in economic growth is much intentional. This is to ease the economic strain that China was getting into and shifted to a more sustainable economic growth. Okay, so that's about it for today's episode. I won't give you guys a conclusion and let you guys come up with your own. However, if you feel like you have learned anything from this episode, consider subscribing for more of such content. And until the next episode, ciao.